Hi guys, and welcome to our podcast. Today we're going to discuss about credit card balance transfer. What is balance transfer? How it actually works, and what are its benefits, and what things you should consider before enabling a credit card balance transfer. So what exactly is credit card balance transfer? A credit card balance transfer lets you consolidate your existing credit debts into one. It might be a good way to save on interest, plus there are other benefits attached to it. All major credit card companies make this feature available to a new credit card holder. This is according to WalletHub's Balance Transfer Policy Report. Not only that, but some issuers even allow the transfer of other loans into the credit card account. Borrowers can transfer their auto loans, student loans, payday loans, HELOCs, payday loans, small business loans, and even mortgages. However, just because the facility is there doesn't mean it's an automatic option for you. Before you decide to do it or not, find out all you can about it. Know how it works, how much it would cost you, and if at all, what effects it would have on your credit rating. Read on as we discuss these issues. The principle behind balance transfer is very basic. Transfer your existing high-interest card balances to a new card with a lower interest rate. This way you technically lesser the rate you're supposed to pay. Effectively, this means that your new card has paid off the balance of your old card or old loan. You've settled your old debt and started a new one on your new card. You can then begin paying off the balance of the new card. You would find this supposedly easier to do because of the significantly lowered interest rate. As an illustration, let's take a look at this scenario. Assuming you have a credit card balance of $10,000 with an interest rate of 15% annually. Using the simplest premise, you would probably pay $238 per month to pay it off in 5 years. It could be more because some credit card companies compute the minimum required payment differently. If you double your monthly payment, it would take you a little bit over 2 years to wipe off the debt. In any case, your interest charges would run up to more than $1,700 in total. If you transfer that balance to a card that offers 0% interest for 15 months, the figure will go down. We'll tell you more about the 0% offer in a moment. Suppose that you can continue to pay twice the minimum amount, you'll pay off the debt in 22 months. The other good thing is you'll only pay about $133 in interest and save close to $2,000. You can already request a balance transfer when you apply for the new card. You can also do it in a later date. Many credit card companies offer introductory balance transfer rates, some of them at 0%, but only for a limited time. This may be available only for the first 6 to 24 months if you apply within the first 30 days. Pay particular attention to the balance transfer fees, especially for the 0% offers. We'll get to that later. Theoretically, a balance transfer might provide you with a great opportunity to get rewards. Many credit card companies offer rewards for usage. The higher the use, the bigger the reward. Card companies count a balance transfer as a usage. Since the transfer usually involves a large amount, they consider it a high-value dollar transaction. This would entitle you to more reward points or bigger instant gifts, depending on the company's scheme. The bad news is, many credit card companies have excluded balance transfer transactions from rewards earning eligibility. Not all of them, though. As of September 2017, only a few credit card brands are offering rewards, inclusion, or other bonuses for balance transfer transactions. These are Discover It and Chase Freedom, to name a few. You'll find out for sure if the card entitles you to rewards by checking the very fine print on the card agreement. Do some calculations on the effect of all the offers on your debt. Just because you can be entitled to rewards does not necessarily mean getting a good deal. Weigh the value of the rewards against the other charges such as the transfer fee. See if it really adds to your benefit. After just a few minutes, you may already be thinking that the balance transfer is a good idea. In a lot of cases it is. Just remember there is another cost involved. They call it a balance transfer fee. A balance transfer fee is a fee imposed by the card company where you're transferring your balance. They will compute based on the amount of debt transferred to the new card. The common transfer charge, as popularly quoted, is 3% or $5, whichever is greater. This means the card company will bill a straight 3% on the total amount you transferred. Also, they will charge it up front, that is, immediately after shifting your debt to the new card. Yes, 3% might not be a big deal by itself, but consider its impact to a large balance. In our example, for a $10,000 transfer, you'll be paying $300 as a transfer fee. So instead of saving around $1,500, you're down to $1,300. Although this may still seem good, it's not as attractive as initially projected. Some card companies waive the balance transfer fee over a certain period. Others don't charge a fee at all. You need to look at each card's offer to find out which one doesn't collect a transfer fee. Many people considering balance transfer may affect your credit score. And indeed, it has an impact on your credit score. The good news is, a balance transfer itself will not hurt your credit standing. Credit scoring companies do not specifically use them to evaluate your credit worthiness. Card companies do not normally note the transfers on their credit reports. However, a balance transfer can change your financial profile and may affect your credit score. There are 3 possible impacts of the transfer. First, it can affect your credit utilization. A balance transfer can modify your credit utilization ratio. The credit utilization ratio is a key element of the amounts owed, or your total credit card balances. Credit scoring companies score the credit utilization of your card separately. Then they calculate your total utilization in whole. If you don't cancel the original card, your overall utilization will go down. On account level, how the new card's utilization level compares against the old card will depend on their credit limits. If limit is higher, you will have a lower utilization ratio compared to the old one. The second impact is that it can lead to a pattern of overspending. If you use a balance transfer to avoid debt payment or support bad spending habits, it will inevitably hurt your score. Before the recession began in 2007, consumers jumped from 0% credit card to 0% credit card to avoid accruing interest. The practice was just to delay the unavoidable and prevent interest charges from accruing. You have to realize that you will have to pay anything you charge to your card, sooner or later. The wise folks who played the 0% game soon learned the hard way. The 0% offers dried up during the crunch, and card companies forced them to pay up. Many of them were unable to pay the balances on their cards, especially given the weight of cheap financing charges. A big number defaulted on their payments and ruined their credit scores. The last thing you should remember is that new credit lowers your score. When you open a new credit card amount, your credit score takes a temporary dive. This may last anywhere from 3 to 6 months. You should be concerned if you have scheduled a major financial event in the coming months, such as a mortgage. Otherwise, you can sleep tight. There are a couple of things to consider before you enable a balance transfer. The first thing is to check your credit score. First cards with 0% offer usually require an applicant to have a good credit standing before they approve. See where you stand before making a choice and sending out an application. After checking the score, decide how much you want to transfer. You have complete control over the amount you want to transfer. You can transfer all of the balance or transfer only a portion of it. Partial transfers are sometimes more beneficial since you can make use of the 0% intro period. Determine how much you can afford to pay for the 0% and for the old regular rate. To find out the proper transfer amount, compute the monthly payments you can afford, then multiply that by the number of months covering the introductory period. As any other product you buy, do a careful comparison of credit card offers. Credit card companies try to outdo each other with balance transfer offers at any given time. Finding the one that would give you the best financial advantage begins with listing the ones you are eligible for. Then do computations to determine the savings that each one will give. You have to take into account the card's given interest rates, transfer fee, and introductory period as applicable. Many make the mistake of focusing only on one feature, usually the length of introductory period. It is prudent to consider the overall impact of all probable costs. Another thing you should consider is to make a sensible payoff plan. If you're going to do a balance transfer, you must do it strategically. Designate your new card for a specific purpose and have an exit strategy beforehand. Many sites offer an online credit card payoff calculator that can help you make a payment schedule. You can find out how much you must pay every month to fully pay the balance within the introductory period. You can also see how much you can save by paying a slightly bigger amount. A balance transfer feature is actually a very good debt management tool. The right card can alleviate interest costs. Ultimately, you can settle your total debt at the lowest available cost. This applies to the different reasons for availing of a balance transfer. You may be preparing to purchase a big ticket item or planning to pay off a revolving balance or consolidate debt. From another perspective, you may also use balance transfers as a savings mechanism. If your bank's interest is high enough, you may temporarily park the funds earmarked to pay for the card. This would only be financially beneficial during the card's introductory period. Just be careful that this strategy doesn't lure you to spend more than you should. The availability of the 0% interest in balance transfer is not a permanent card feature. You should therefore keep in mind that you will probably have to pay interest when the introductory period is over. If you're fortunate to be able to do another transfer down the road at 0%, good for you. Hoping that it will always be available might just lead to disappointment. Last but not least, remember to fight the temptation to buy things with your balance transfer card. If you use your new card to make purchases and revolve your credit, you will not have a grace period. Unless your card has a 0% feature on all purchases, your purchases will accrue interest. Good financial sense dictates that you should not pay more for anything. Good financial sense dictates that you shouldn't pay more for anything than what you have to. So be cautious. Use different cards for your purchases, preferably ones that give you rewards for usage. You may use your balance transfer card only if you have wiped off your transferred amount. That's it for now. On our website you can find more posts and podcasts as well as calculators and other financial tools. Do you consider balance transfer? We would love to know your thoughts, so feel free to share them on the comments below. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube.